Hello friends, welcome to Wow IS. We are going to start with the June 2023 current affairs. This is a part 1 of the June 2023 current affairs and we are going to cover the economics portion first. We are discussing this under our initiative in which we are providing you crisp summaries of the Vision Monthly magazine for the year 2024. It is available at a price of only 599 rupees. The videos are free for all. You can access those videos from the YouTube channel. However, for the PDF, you need to enroll in our course. You can directly enroll by paying through this QR code visible on the screens and send us the payment detail, or you can use the link available in the discussion video to enroll in the course. So let's start with today's topic. The first topic is economy. In the economy, the first topic is state capital expenditure. So the Department of Expenditure, Ministry of Finance has approved rupees 56,415 crore in 16 states under Special Assistance to State for Capital Investment 2023-24 scheme. In this scheme, the other parts are incentive for scrapping old vehicles, urban planning reforms, financing reforms in urban local bodies, housing for police personnel within the police station area, then construction of Unity Mall to promote national integration, children and adolescent infrastructure libraries and digital, and incentive for implementing timely release of CSS funds by state government to vendors and beneficiaries. Now, what is under this? What is about this special assistance to state for capital investment fund? This was launched in year 2020-21 in the wake of COVID-19 pandemic. The objective was to boost capital spending by states, and the special assistance will be provided in the form of a 50-year interest-free loans to the state governments. Now, if we talk about what has been the trend of capital expenditure by the states, now the subsidies burden has increased in the expenditure part, and the capital spending has actually slowed down in the financial year 2023. The capex growth was flat in this year as compared to 29% growth in financial year 2022. So this year comparatively, we didn't had much growth in the capital investment. Then capital outlay to GDP ratio. States capital outlay to GDP ratio is expected to improve from 2.3% in 2021-22 to 2.9% in 2022-23. Debt to GSDP or gross state domestic product, it is highest for Punjab at 48%, then followed by Rajasthan and then by Haryana. According to Bank of Baroda, 25 states have cumulatively achieved 76% of their capex target in this financial year 2023. Now, significance of capex by states. First of all, it produces a multiplier effect. It helps in crowding private investment and easing critical supply constraint. It also helps in future growth by creation of employment and capacity building. Then it helps in inclusive growth as the quality of public expenditure with focus on infrastructure, research and development, health, education and other social services can play a conducive role in promoting inclusive and sustainable economic growth. Now, encouragement to states for capex. The center is offering a 50-year interest-free loan for capex. Capex means capital expenditure under the said scheme जो हमने अभी डिस्कस किया. Then the central government has regulated states borrowing under Article 293 of the Constitution from financial year 2023. Then what are the reasons for failure in increasing capex by states? Limited fiscal space. States are legally mandated under the FRBM Act to keep their fiscal deficit under control. Unable to reduce their revenue expenditure on salaries, pensions, subsidies, etc., they end up cutting down on capex to meet the deficit norms. Then lacking capacity in terms of project or skills in absorption of high capital expenditure. Then decision making on political consideration. These are state level political disruptions such as state instability, government instability or elections which come in the way of decision making pertaining to the capex. Now what can be the way forward? First of all, channelizing capex through direct and indirect channels. The direct channels include involving directly on public infrastructure and human capital. Indirect channels include by crowding in private investment, promoting good governance, attracting foreign direct investment or FDI, especially into technology, telecommunication, banking, financial services, insurance, retail and consumer facing services. Then fiscal prudence through financial commission. Need for a council. There is a need for supervisory bodies such as expenditure council whose role will be to formulate guidelines and foster agreement on best practices for state government in terms of resource allocation. Increase in revenue resource. Then rebalancing expenditure. State with suboptimal expenditure patterns like low social sector spending, low capital expenditure and high committed expenditure relatives should undertake correction through rationalization or rebalancing of expenditure. Then capex buffer. States must mainstream capital planning and consider creating a capex buffer fund during good times to maintain expenditure quality and flow through the economic cycle. The next is urban cooperative banks. The urban cooperative banks can now open new branches up to 10% of the number of branches in the previous financial year without prior approval of the RBI in their approved area of corporation. The FSWM criteria to avail this facility, the UCBs have to get policy approved by their board and comply with the financially sound and well managed norms. So this is the condition for it. Cooperative banks through board approved policies may provide process for technical write-offs as well as settlement with the borrowers. Then the timelines for UCBs to achieve priority sector lending targets is by 2 years, that is by March 31, 2026. Then RBI has notified a nodal officer to meet the long pending demand of the cooperative sector for closer coordination and focused interaction. So now the coordination has been improved. Now, what is the criteria for FSWM status? First of all, CRAR should be at least 1 percentage point above the minimum CRAR applicable to an UCB. NPA should not be more than 3%. Net profit for at least 3 out of preceding 4 years subject to the not having incurred net losses in the immediate preceding year. Then no default in maintenance of CRR or SLR during the preceding financial year. Sound internal control system and 2 professional directors on the board. Then core banking solution fully implemented. No monetary penalty imposed on account of violation of RBI guidelines during the last 2 financial years. Now categorization of UCBs. First of all is the tier 1. It includes all units UCBs and salary earners UCBs irrespective of deposit size and all other UCBs having deposit up to 100 crores. Tier 2, it includes UCBs having deposit 100 to 1000 crores. Tier 3 include having deposit 1000 to 10,000 crores and Tier 4 includes having deposits more than 10,000 crores. So these are the various categories of urban cooperative banks. Now let's talk about something about urban cooperative banks. The government has brought the Banking Regulation Act of the government has amended the Banking Regulation Act of 1949 and brought the cooperative banks under the direct supervision of RBI. Now RBI has got power to supersede the board of directors of the cooperative bank after consultation with the concerned state government. Earlier, the multi-state cooperative banks used to be under RBI. Now the banks which are having presence in only one state will also come under RBI's ambit. But there should be consultation between RBI and the state government before the RBI supersedes the decisions of the board of that cooperative bank. Then minimum net worth. Tier 1 UCBs operating in a single district should have minimum net worth of rupees 2 crore. For all other UCBs, the minimum net worth should be 5 crores. Then capital to risk weighted asset ratio CRAR. Tier 1 UCBs have to maintain a minimum CRAR of 9% of the risk weighted assets on an ongoing basis. Tier 2 to 4 UCBs have to maintain a minimum CRAR of 12% of RWAs on the ongoing basis. Then priority sector lending targets. 75% of their advances have to comprise PSL, including loans to MSMEs, export credit, housing, education, agriculture, among others. Now, what are the issues with UCBs? Higher gross non-performing assets GNPA. As per RBI, FSB report 2023, gross NPAs ratio for UCBs was 8.7%, where it was just 3.9% for scheduled commercial banks. Increasing competition from scheduled commercial banks as well as small finance banks and payment banks. Then there are issues with respect to governance. Vulnerability stemming from internal weakness, including inability to prevent fraud from, for instance, the collapse of Punjab and Maharashtra Cooperative Bank in 2019. And due to this collapse only, these amendments were brought. Next, inability to adopt best practices. Low capital base doesn't allow them to deploy requisite resources in either manpower in technology. Then high influence of top management. Often the chairperson has significant influence over all the matters. Then high cost income ratio. They fail to cooperate efficiently as their cost income ratio remains on the higher side. The average ratio is roughly 10% higher as compared to the commercial banks. So these are the challenges with respect to the urban cooperative banks. Then also they face high credit, market and liquidity risk. RBI's Financial Stability Report 2023 found that a few UCBs are highly vulnerable to credit risk, market risk and liquidity risk. Then low share in banking sector. Market share of UCBs in the banking sector have been low and stands at around 3%. Now, what is the importance of UCBs? They offer loans at a very reasonable rate. They help in economic upliftment of the weaker section, that is financial inclusion, you can say. Then they help in large untapped area of expansion. They lead to large untapped area of expansion. Then they also allow for massive financial inclusion quotient. Predominant domestic orientation is there. Then good network at the grassroots level and tailored to serve the local needs. Now, what are the other initiatives taken for overcoming the issues of UCBs? First of all, supervisory action framework. It seeks expeditious resolution of UCBs experiencing financial stress. The SAF entails initiation of cooperative action by UCBs, supervisory action by RBI on breach of specified thresholds. Scheme for voluntary conversion. RBI has announced a scheme for voluntary conversion of eligible UCBs into small financial banks in 2018. Then umbrella organization. The RBI has accorded regulatory approval in 2019 for formation of an umbrella organization for the UCBs. The approval inter alia permits UCBs to subscribe to capital of the umbrella organization on voluntary basis. It is also expected to set up an information technology infrastructure for shared use. It can also offer fund management and other consultancy services. So it will give a boost to the cooperative banks. Now the third topic is critical minerals. Ministry of Mines have presented its first ever report on the critical minerals of India. The list comprises of 30 critical minerals and 17 rare earth metals and 6 platinum group elements. So this includes 17 plus 6, 23 and total it is 30. The rare earth metals includes 15 lanthanides plus scandium and yttrium. So there are 15 lanthanides and scandium and yttrium elements are there. The rare earth metals are classified into two parts, light rare earth metals and heavy rare earth metals. The criticality of mineral is judged by two parameters. The first parameter is economic importance, second is supply chain. Economic parameters include disruption potential. If the supply is stopped, what can be the disruption due to that lack of element in the supply chain. Then substantiality index, then GVA multiplier score and cross-cutting index. Supply risk, governance weighted mineral construction, end of life recycling rates and import reliance and self-sufficiency. The next is substitutionality index. What are critical minerals? Critical minerals are elements that are building blocks of essential modern day technologies and are at a risk of supply chain disruptions. For example, antimony, beryllium, bismuth, cobalt, copper, etc. For India, major import sources of cobalt are China, US, Japan, Japan. Then for lithium, we have Chile, Russia and China. For nickel, Sweden and China. The core objective of India's critical mineral identification process is supporting economic growth, competitiveness and job creation, driving research, innovation and exploration, then enhancing global security and partnership with allies, raw material security for state-of-art defense and promoting climate action and environmental protection. Next is significance of the critical minerals of India. Economic growth. Minerals such as lithium, graphite, cobalt, titanium are essential for the advancement of high-tech electronics, telecommunication, transport, etc. Self-sufficiency in critical minerals ensures self-reliance and addresses the vulnerability in its supply chain. Then promoting climate action. Some critical minerals are important for climate-friendly technologies such as electric vehicles, solar panels, and wind turbines. Defense. Critical minerals such as lithium, nickel, and silicon are vital to manufacturing technologies and minerals used in aerospace and defense sector. Security. Critical minerals are necessary for India to achieve its geo-economic goals, energy security, renewable energy goals, mineral security, commitment to electrical vehicles by 2030. So this is the importance of these minerals. What are the concerns that we have? First of all, we are heavily dependent on the imports. For example, some critical mineral assets for countries' manufacturing sector, particularly green technologies, are not ready to be mined. Then there are supply chain issues. Geographical concentration of extraction and processing in a few locations may lead to supply chain disruptions or vulnerabilities. For example, 3/5 of the rare earth minerals essential for clean energy, electronics, defense technologies are mined in China, while fourth, fifth are processed in China only. So we are heavily dependent upon China. Then trade policies. The supply of critical mineral is dependent on the trade agreements which can be driven by domestic interest. For example, Indonesia, which hosts world's largest nickel reserves, have banned export of the raw nickel ore as they seek to develop domestic nickel processing industry. Next is lack of periodic assessment, limited substitutes and recycling. These minerals lack substitutes and have low end of life recycling rates. Then pillars of critical minerals value chain. First of all, midstream processing, refining, metallurgy. Then upstream mining and extraction. Downstream component, manufacturing and clean digital and advanced technology production. Upstream exploration, material recovery and recycling. Then what are the initiatives taken with respect to critical minerals? India-Australia Critical Mineral Investment Partnership is there. Second is Mineral Security Partnership, which is the US-led collaboration of 14 countries aiming to catalyze public and private investment in the critical mineral supply chain globally. Then India is having Mines and Mineral Development and Regulation Amendment Bill of 2021, which enforces transparency and enhances domestic and foreign investment in mining sector. Then Supply Chain Resilience Initiative is there, where India, Japan, Australia unveiled the SCRI to enhance the resilience of supply chains of Indo-Pacific region and reliance on China. Then next is way ahead. What is the way ahead? First of all, the recommendations made by the Ministry of Mines are: establish a National Institute of Center for Excellence on Critical Minerals, create a separate wing in Ministry of Mines known as Center of Excellence for Critical Minerals, then collaborate with international agencies. Innovation funding mechanism should be there, which focuses on processing and refining technologies, and update the list of critical minerals periodically, preferably every 3 years. The national framework. The government needs to plan a national framework for sourcing its reserve for critical minerals, including lithium, to accelerate indigenous development of cells, create a reliable value chain. So with this, we complete the day one. Next, we are going to come up tomorrow with the semiconductor industry in India. So thank you very much and have a very nice day.